Don't fight the Fed, which probably isn't finished raising rates. That is the word from our next guest. Gary Kaminsky is the chairman of Magnifi Plus, the former Morgan Stanley Wealth Management vice chairman as well. And he is back with me at Post 9. It's good to see you again.
Good to see you. What a day to be downtown.
I'll tell you what. So you describe yourself as cautious broadly, but not bearish. What does that mean?
Well, I think what the first quarter showed you, Scott, is that if you are an investor, you have to be invested. And I was surprised with the averages. Averages obviously was skewed by a couple of big stocks. But this is a time where don't fight the Fed is not some cliche that is not known by almost all investors. But we're raising rates. The Fed is going to continue to raise rates. And now is a time not to speculate in equities, but to make certain that you know what you own. The markets have always operated in cycles. I've seen it for close to 40 years now.
Sure.
That's where we are.
But you know as well as anybody in the markets that you've watched over those 4 decades, you don't fight the Fed forever. And the Fed is certainly closer to the end than the beginning. So at what point do we start to think over the rainbow, so to speak, when they're done?
Well, again, I've listened to many people talk about it over the last 6 months. And the real simple answer is nobody knows. My personal opinion is I think the Fed is going to overshoot this time. They got it wrong with inflation. It wasn't transitory, and I think that their belief now is to overshoot. So in that case, is it 6 months before the end of the tightening cycle?
6 months? You think that long?
No, I don't know when the market starts to look forward. I have no idea. When I listen to people prognosticate about a pause and that now you've got to be fully invested on that basis, I don't think anyone knows the real answer. You have to have an opinion on interest rates. It's probably the most single important factor as it is with equity investing.
Have they peaked?
I do not believe they've peaked. I think the Fed is determined to overshoot this cycle, and I would not be surprised personally to see a 6% terminal rate.
Really? You think they would go that high even after what we witnessed with SVB and what is still expected to be credit tightening?
Well, that's what they want.
Yeah, but they don't want the whole system to blow up.
But that's why there was a backstop put in place to sort of mitigate what happened with SVB. I do not think that this is the end of, I don't call it a banking crisis. I don't believe this is the end of what we saw a couple of weeks back. I think you've got this duration mismatch at a number of banks, given what has happened in terms of funding and in terms of assets. So that is something that the Fed is not upset that this will have an impact in credit tightening. At the end of the day, raising interest rates, that's what that's about.
You agree with Dimon then, right? Jamie Dimon, JPM, in his annual shareholder letter. As I write this letter, the current crisis is not yet over. And even when it is behind us, there will be repercussions from it for years to come.
I would agree. I think that the way assets are moving to the big banks will have ramifications in terms of the ability for smaller businesses to get credit. I think that's what Jamie's talking about in that letter. I don't think it's a crisis. I think this is the type of movement that happens when interest rates are going up. Interest rates go up for a reason. And this is exactly what the Federal Reserve is trying to do in terms of slowing down the economy, because inflation is what the target market is.
Would you own the banks here?
Well, the kind of stocks that I would own in this part of the cycle are companies that pay dividends and distributions and reinvest those dividends and distributions in their own businesses when they're not paying it out to shareholders. Because we are in the time of the cycle. You know, I've never lost fact of the fact that depending on when your starting point is, 40 to 60% of the return of equities over the long term, the 10% number that's thrown out there all the time, half of that is dividends and distributions reinvested. It's not capital appreciation. It's not talked about that much, but you are in the part of the cycle now with the equity markets where companies that pay you dividends and distributions is much more important than capital appreciation.